Let me tell you about a restaurant you've probably never noticed, even though you eat there every single day. This restaurant has an interesting business model. They don't actually want customers who order food and pay for it. Those customers are boring. Low margin, not worth the table space. This restaurant makes its real money from a different kind of customer entirely. They make money from the people who forget to cancel their reservation and get charged anyway. They make money from the people who accidentally order off the secret menu and get hit with a surprise bill. They make money from the people who show up 5 minutes late and have to pay a $35 timing adjustment fee. And here's where it gets dark. If you're a customer who always shows up on time, pays your bill, orders normally, and never makes a mistake, the restaurant doesn't just ignore you. They actively try to trip you up. They send you coupons that expire in 24 hours. They accidentally add items to your bill. They keep moving the entrance so you're more likely to be late. And when none of that works, they lobby the government to make sure the timing fee stays at $35 instead of getting capped at $5. You might be thinking, what kind of insane restaurant would operate this way? The answer is your bank. And if you have around $30,000 saved up, I need you to understand something that's going to fundamentally change how you see your relationship with your financial institution. You are the customer they're trying to break. You are the responsible saver they want to convert into a borrower. And when they can't convert you, they lobby Congress to make sure they can keep extracting money from everyone else. My name is Noah, and I spend way too much time thinking about the hidden mechanics that determine who builds wealth and who stays stuck. Hit that subscribe button and give this video a thumbs up. The conversion war. Once you see it, you will never look at your bank the same way again. Banks don't just find responsible savers unprofitable. They actively resent you. Every dollar you have saved is a dollar you're not borrowing. A dollar you're not borrowing is a dollar that's not generating 22% interest for them. According to Federal Reserve data from Q3 2025, the average credit card APR is 22.83%. The national average savings rate, according to the FDIC as of late 2025, is 0.39%. That's a 22-point spread. On every dollar you borrow, they make 58 times what they pay you for your deposits. When you save $30,000 instead of borrowing it, you're costing them potential revenue. You're a conversion failure. You're proof that their psychological tactics didn't work on you, and they hate that. The conversion war. Every single interaction you have with your bank is designed to do one thing: turn you from a saver into a borrower, from a depositor into a debtor, from an asset into a revenue stream. Think about the last time you logged into your bank account. What did you see? You're pre-approved for a personal loan up to $25,000. Increase your credit limit with one click. Low introductory APR on balance transfers. You qualify for our premium credit card. This isn't customer service. This is targeted psychological warfare. The marketing ROI of existing customer cross-sell efforts is typically 10x that of new customer marketing. They're not trying to help you. They're trying to convert you. They analyze your transaction history, your deposit patterns, your credit score changes, and your demographic information. That pre-approval notice didn't arrive by accident. Their algorithms determined that you fit the profile. When you paid off a loan, they noticed. When your income went up, they noticed. When you had a large expense, they noticed. They crafted an offer specifically designed for that moment of potential weakness. You with your $30,000 saved? You're a failed conversion. Every time you log in, they're going to try again. Now let me show you how the hate goes from passive to active. In December 2024, the Consumer Financial Protection Bureau, the CFPB, finalized a rule that would have capped overdraft fees at big banks at $5 per transaction. This rule would have saved American consumers $5 billion per year. 23 million households who pay overdraft fees. What happened next? The same day the rule was finalized, the American Bankers Association, the Consumer Bankers Association, and other banking trade groups filed a lawsuit to stop it. American Bankers Association, Consumer Bankers Association filed suit. They called it unfortunate that they had to turn to the courts to fight the CFPB. Banking industry groups successfully lobbied Congress to overturn the CFPB rule entirely. The Senate voted 52 to 48 to repeal the overdraft fee cap. Banks spent millions of dollars lobbying to keep the right to charge people $35 for overdrawing their account by a few dollars. You're not paying overdraft fees. You're not the one getting hit with $35 charges. But the banks need someone to pay those fees to make up for the fact that you're not profitable enough. 9% of bank accounts generate 79% of all overdraft revenue. Banks collected $12.1 billion in overdraft and NSF fees in 2024. Your free checking exists because someone else is paying $700 per year in overdraft fees. The deposit beta. How banks steal interest rate increases from you. When the Federal Reserve raises interest rates, banks are slow to increase what they pay you. When the Federal Reserve lowers interest rates, banks drop your savings rate almost immediately. Deposit rates are upward sticky and downwards flexible. The Fed cut rates by 175 basis points in 2024 and 2025. The top high-yield savings accounts dropped their rates quickly in response. During the rate increase cycle from 2022 to 2023, traditional banks barely moved their rates at all. While the Fed was paying over 5%, the national average savings rate never got above 0.6%. They kept the difference. This isn't an accident. This is intentional. This is your bank taking money that should be yours and keeping it. The major traditional banks were paying 0.01% to 0.05%. On your $30,000, that's the difference between earning $1,200 per year and earning $3 per year. They're not offering you low rates because they have to. They're offering you low rates because they can. Inertia is their business model, the trap they build specifically for people like you. The dead zone. Below you are the profitable customers, the overdrafters, the revolvers, the people generating fees and interest. Above you are the wealthy customers. Chase Private. Client requires $150,000. Bank of America's private bank wants $3 million. Citi Private Bank, $10 million. You're in the middle. Too responsible to generate fee income. Too poor to qualify for premium service. Banks are raising their minimums. The gap is growing. On purpose. By design. You're not being ignored. You're being squeezed out. I know what some of you are thinking right now. Okay, so banks are businesses. They're trying to make money. That's not hate. That's just capitalism. But here's where it crosses a line. When banks lobby to stop consumer protections that would save struggling families $5 billion per year, that's not just business. When banks pay you 0.01% interest while earning 5% on your deposits, that's not just capitalism. When banks spend millions on algorithms designed to catch you at your weakest moment with a credit offer, that's not just marketing. That's a system designed to extract maximum value from financial vulnerability. When you refuse to be vulnerable, when you save $30,000 and stay out of debt, you're not a customer they appreciate. You're a customer who escaped, and they're going to keep trying to catch you. So what do you actually do with this information? I want to give you a framework I call the escape strategy. Step 1. Stop letting them hold your savings. Move it to a high-yield savings account at an online bank paying 4% or higher. Same FDIC insurance. Same safety. 10 times the return. On $30,000, that's an extra $1,000 per year in your pocket instead of theirs. Step 2. Stop being their target. Unsubscribe from their marketing emails. Turn off credit offer notifications. Set your communication preferences to essential only. Step 3. Use credit unions instead. Credit unions are not for profit. They don't have shareholders demanding maximum extraction. When they make money, it goes back to members as better rates and lower fees. At a credit union, your $30,000 makes you a valued member. At a megabank, you're a rounding error. Step 4. If you want to invest, go where your interests are aligned. Brokerages like Fidelity, Schwab, and Vanguard make money when your assets grow. That's alignment. Your bank wants you to borrow. Your brokerage wants you to save. Choose accordingly. Step 5. Keep minimal money with big banks. Big banks still have value. ATM networks, fraud protection, convenient apps. Keep a couple thousand in checking for daily transactions. Use their infrastructure. But don't give them your savings. Don't let them hold your wealth. You've escaped something that catches most people. According to the Federal Reserve, the median American has about $8,000 saved. You have nearly 4 times that. Americans paid $12.1 billion in overdraft fees in 2024. You paid zero. Americans are carrying $1.21 trillion in credit card debt at an average of 22.8% interest. You're not part of that. Your bank doesn't value you for it. In fact, your bank actively resents you for it. Good. Let them resent you. Your $30,000 isn't just money. It's freedom. It's options. It's the ability to walk away from a bad job, handle an emergency, or take a risk on something you believe in. That's worth more than their approval. You won. And they hate that you won. Wear their hate like a badge of honor. Share this with someone who's been feeling like their bank doesn't care about them. Share it with the friend who has savings and wonders why they're invisible. They need to know the game is rigged. They need to know they're actually winning by refusing to play. If their bank seems hostile, it's because they've escaped. Thanks for watching. I'll see you in the next one.